Well, hello, I'm Richard Jeffries, and I'm really excited to be able to bring this webinar to you, which is all around buying your next investment property. That might be your first, or it might be a number of properties that you've already purchased. And the idea of this webinar is to show you the correct way to structure purchasing an investment property, but also whether or not now is the right time to purchase an investment property for you, and what the banks will look for when it comes to obtaining finance to do so. I've been fortunate enough to be mortgage broking over 18 years. In that time, we've assisted hundreds of Australians with purchasing property, and we do really see the right ways to structure the property versus ways that can lead to mistakes and errors that can cost thousands of dollars if not done correctly. So I'll kick things off, and in doing so, we'll share my screen. But yeah, obviously we do get a number of people come and talk to us about having the ambitions of wanting to purchase an investment property. Australians have always been looked very favourably on real estate, and real estate is one of the means that you can start to create wealth, and do so, purchase an asset that will hopefully provide you a good income, and some addition to that, some good capital growth as well over time, can assist with your retirement plans. So a little bit about us. So I started Newbridge Home Loans a number of years ago, and we've been fortunate enough. We've actually got over 200 now 5-star Google reviews. Being a mortgage broker, our role is to go to the lenders on our panel, which total over 25, and try and source you the best loan from that group of lenders. We get paid by them, so it is a free service for you. And to be able to sit down and see what your options are, it's just a matter of jumping on our website, mynewbridge.com.au, and you can book a free appointment at any time to see how much you can borrow and what the repayments will be, and all those sort of things that you'd be interested to know when considering an investment property. When we do look at finance and our banks look at your finance application, we put together a really simple process we refer to as the 5 L's of lending. And this is what we're going to talk through today. We're going to start by having a look at your level, how banks determine how much you can borrow for an investment property, then what type of loan you should be considering, which lender, lodging your application for pre-approval for an investment property, and then we're with you for the life of the loan. And that really means keeping an eye on your interest rate and being able to provide you with any further financing options you need in the future. So when we look at purchasing property for an investment property, it comes back to your deposit, or in a lot of cases, the level of equity you have in your existing home, to try to see if that is sufficient to use as a deposit for an investment property. So if we have a look at an example to try and understand if someone would have enough equity for an investment property, in the blue, we're going to look at their existing house. So this is their owner-occupied property. The banks would refer to it, in other words, the place where they're residing, and they want to keep residing in that property, and they want to buy a new investment property. Now you can see I did do the slides a little while ago, so some of these prices might not be realistic for the areas that you're living or looking in. However, the idea remains the same. So if we had a property valued here $450,000, the banks will allow you to access equity up to that of 80%. So in that case, it would be $360,000. Now, keep in mind that does include any debt that you already owe. So in this case, this family has a loan already of $200,000, which means there's $160,000 available to use as a deposit on the new purchase. So what we're doing is we're using equity in this property, we're borrowing against it to use as a deposit on the investment property. And the reason we do that is that it's tax deductible, the debt, even though it's secured against their own home. So you can see in this instance, because we're looking for a property for $400,000, we need a deposit to access equity up to 20% of that amount. So that's $80,000, plus we need to cover the costs. So in Queensland, we worked that out. So the total we need for a deposit on this property is $95,600. The reason is that it is in orange is because it is a tax deductible loan, because it's been used for investment purposes, but it is secured against the owner-occupied property. If you were wanting to buy an investment property with cash and you didn't have any other property to use As equity, then you would simply need to come up with a deposit of 95,600, and you'd put it straight into that property here. So what we've done is we've drawn down a new loan of 95,600 to use towards this property in orange, and then we've just got one more loan to apply for, and that's a loan of 320,000, which is the 80% remaining required to fund this property. Now, this is the most common way, and the way I would suggest in most cases to structure an investment property purchase. The reason being is that what it does is if you ever sell this property in the future, it's only this loan here that needs to be cleared. Okay, this loan here stands on its own. Is linked to the personal home, and so is this one. They're not cross-collateralized. Now, that's a term that gets used a lot in banking, and what that means is where the two properties are linked, and therefore, if you sold this property, the bank has the right to take any extra cash over and above the loan that's owing on this property and use it to reduce debt here. And that may not be what you want to use the cash for. So in this instance, we usually suggest keeping the property separate and just taking out a small loan for the deposit, being loan 2 on this property, and therefore avoiding having to cross-collateralize the properties. There are times when it might make sense, but in this instance, and for the main, we're going to assume that we're going to try and keep things separate. Over time, what an accountant or financial planner would usually suggest is to try and pay off this loan in blue first, and then attack the lending in orange, because at least with the lending in orange, you're going to get some sort of tax deduction if it's negatively geared. And we'll go into that in a little bit later. So that gives you an idea of how to work out if you've got a sufficient equity. We'll have a look at the value of your property, take it up to 80%, and then take away the existing amount you owe. Whatever's left is potentially what you can use as the deposit for a new investment property. Now, I say potentially because there are still other criteria that the banks will look at. So this is how it would look if you did cross-collateralize the property. So what the banks would simply do is look at the total value of the properties being 850, the total lending being that, and as long as it's under 80%, they would just link them together, which is not what we want to do in this instance. So that covers the equity side of things. Now we're going to look at how the banks determine how much you can borrow based on your income and your expenses, because that's the second part to our level as our 5 lending. So they're going to look at all your income, and rental income is going to form part of this. So if you are saying to the bank, look, I want to get this loan to buy an investment property, and they can see it, you've got a contract for the property, or you will have when you finalize the approval, then that can be taken into account to assist with your borrowing power, but it's usually not going to be enough. You're usually going to have to obviously show a surplus with your wages and your other expenses. The banks will work out, okay, once they take into account all your income and all your expenses, what is left to go towards the repayments on a new loan? And is that enough? Keep in mind, banks will assess you at about 3% above what the home loan interest rates are. So at the moment, rates are around the 6.5% for investment lending. That means they're going to be seeing if you can afford lending at 9.5%. Okay, so now all you can see here is how the bank's assessment works. So in this case, these people have slashed their credit card limits and their borrowing powers around that 567. If they took it further and got rid of their car loan, you can see that it's going to even go up to 653, and then whereas if they did none of those things, it would be back down at around the 452. So some big differences can be made by just reducing these items, remembering that banks will look at the limits on your credit cards rather than what's owing. Okay, so really important, look at your limits. You don't want too many credit cards, and you don't want too high limits, otherwise that's going to affect your borrowing power in a negative way. Now, the third criteria the banks will look at to determine whether you're eligible for a loan is your credit score. So they're going to look at this number, and hopefully it's in the green. Really anything above probably 550, 600 is where it would need to be for a successful application. And some really important factors are that you're paying your credit card on time, you're not going overdue there, because if you do, and your credit card's with another bank, the bank you're applying for is going to be able to see it. Okay, the banks can see your conduct across all your accounts, whether it's with them or another institution. So it's really important to keep on top of your payments with credit cards, car loans, all those sort of credit facilities, even phone bills, telco accounts as well. Also, you don't want to be going around applying for credit too often. If you apply for a credit card more than sort of 3 or 4 times within the space of 6 months, that can start to go against you. Also, you don't want to go right up to the limit on your credit cards. We spoke about it earlier, but if you can keep your spending within 20 to 30% of your credit card limit, that will look good. Applying too often does show a dependency on credit, and that's why banks often don't like that. So if we look at a loan comparison, how do you structure your investment property purchase? Well, do you take the loan as principal and interest or interest only? In this instance, we've got a loan for 615,000, and the principal repayments are 3,361 a month, whereas interest only is 2,822 a month. Now, keep in mind that interest only means you're literally just paying the interest on the loan, and that's it. You're not paying the debt down at all, whereas principal and interest, you are paying the debt over time, which is a good thing. However, you may find that it's better for you to take an interest-only loan and use the extra money that you'll have each month as opposed to a principal interest loan, and use that to reduce your personal home loan. That's something you may want to get some advice on for a financial advisor, but that is one strategy we do see a lot of people use. However, if you're someone who just likes to get rid of debt, then a principal and interest repayment is going to do that. It's going to be set and forget, and you're going to be paying it off over time. You're not going to have to think of it. So the advantage of going that option in the blue is that it's a forced way of saving, and it does usually have a slightly better interest rate as well, as opposed to the orange interest only version, is that the repayments will be lower, so it'll be easier to hold the property, and it allows you to direct more funds into paying off your personal home loan, but it does mean that you'll have a slightly higher interest rate. So it does come at a price. When it comes to then, once you've worked out the type of loan, whether you want to look at principal and interest or interest only, it's then a matter of choosing your lender. So as I said, as a mortgage broker, this is probably one of the areas we can assist the most, is we can bring all the different offers of the bank to you, so you can quickly and easily see what they can offer you and which lender is going to be the most competitive for you to use. When we do that for you, we provide you with a recommendation that shows you that from our panel of 25, the top 5 options we've recommended, and then that way you get a really good comparison of who's going to be most competitive. Now, obviously, for most people, you'll have an existing mortgage in place. So the question then is whether you should stick with your existing bank or go to a new lender. And there's some pros and cons to both, but really the pros of using your existing bank are you may get a slightly better interest rate, but it's usually not overly significant. Potentially you'll save some money on fees, because if you've got all your lending with them, they'll often only charge 1 annual fee, excuse me, rather than 2 if you've got it separate across different lenders. And you may really enjoy that level of convenience. But some disadvantages to using just one bank for all of it is that it may be difficult to refinance in the future, because you may have it all tied into one. And one bank does really hold all the cards. So if you do have some sort of, I guess, discrepancy with them, they are in a position of power. They do hold mortgages on all your properties. And as we said with cross collateralization or cross securitization, is that if you sell one property and they are linked, they may have the ability to take those funds and use it to pay down debt when that may not have been your intention. So we often find the most common way we approach this with people is that we do use different banks. And that's simply because, the interest rate for your existing personal home loan may be a great one, but it's quite often not. That lender quite often is not the one offering the best rates for an investment facility. So we find some advantages in splitting them out that way. If you do want to know about your options, I spoke about it earlier, but if you do want to know about your options with investment, it's really simple to book an appointment with us. You can do that on video or via Zoom, or in person, whatever's more convenient. But simply jump on to our website, mynewbridge.com.au, click book an appointment. Our availability will come up. They'll give you lots of suggestions to pick a time that suits you, and you can do that. That video call will run through and look at what your equity position is. Is it sufficient to buy an investment property? What your borrowing power is based on your income and expenses, and what maybe you can do to improve that. We can even have a look at your credit score at the moment, give you an idea of how that looks. But more importantly, we can project and show you, all right, is an investment property, is that the right thing to do for you at the moment? And the way we often do that is project and have a look at the numbers and go, all right, we do look at an investment property for 650,000. What's that going to mean for repayments? Is it going to be negatively or positively geared? Most of the time, it is negatively geared if people are borrowing using equity and borrowing the lot. Reason being is you're borrowing money at 6.5%. Most residential investment properties in Australia are probably returning 3.5 to 4% as a rate of return. So obviously that means that it's going to be negatively geared because you're borrowing money at a higher interest rate than what that property is returning you in income. So you really only want to be doing it if you're very confident it's going to continue to appreciate in value, because otherwise, why would you buy an investment that is costing you more than it's bringing in? But you can have a look at all your options and more. There's no obligation, free appointment. Simply visit that website, mynewbridge.com.au, and book an appointment. Or, of course, you can call us directly to do so. But I'm Richard Jeffries. I hope you've enjoyed this webinar. I certainly have, and I hope you've gotten a lot out of it. I know there's certainly more to know about investing in property. And as I said, we can do that with a free Zoom call when a time suits you. Thank you.